right, let's bring in Amy Wu Silverman. She's the head of derivative strategy at RBC Capital Markets. And Amy, the key word for you is volatility. You say your volatility jokes still have some legs here. You want to tell us some?
Yeah, I mean, they're really bad. They'll make my kids cringe, but my favorite...
Dad jokes?
Yeah.
I'm listening.
Yeah, I mean, you can use them as dad jokes if you
listening.
want. But look, it's this idea that there's this other options Greek out there. It's not delta, gamma, vega. It's tweeta. It's the sensitivity of implied volatility to Donald Trump's tweets. And it's kind of a joke, but kind of not, because every portfolio manager out there is managing their portfolio way more to tweeta than anything else right now.
Truth Social.
Yeah. You know, I subscribe to it, obviously, for market reasons, and the amount of sheer tweeting that you get and how much you have to react to that is something that we all have to think about. And, you know, it's interesting because VIX is subdued right now. It's sub 20 handle. But we know those volatility potholes are out there. We saw them April 2nd. We saw them August 5th. And I think the concern is they're really down the road, you know, because I hear you asking about, well, when do we see things hit? Is it September? Is it October? You see that in the term structure of the market, Becky. Like you see that very bearish sentiment rise as soon as we get to that 3-6 month space in options. It's telling you folks are still pretty cautious. They're just not cautious for the near term as we wait and see.
You do say, though, that there is some really promising bullish indicators, especially when you look at small caps for the short term. Yeah,
and it's interesting because I would characterize the market right now as hoping but not hopeful, and these are sort of hoping trades. So I think a lot of the extreme bullishness you're seeing in small caps is one. Likely some part of it is short covering, but the other part is a little bit of a rate sensitivity play, and then a little bit of if tariffs do come out and they are better than expected and you get that resiliency, then you're going to see that right tail in small caps first. And the market doesn't want to get caught whipsawed the way they did during the Liberation Day round trip, and institutional investors really lagged there. They don't want that to happen again. So they have their thumb on the right side of the scale because they are bearish.
And I liked your description for what happened to investors, institutional investors too. Right after Liberation Day, you say they were basically frozen.
Yeah.
Deer in headlights sort of situation.
You know, it's interesting because a lot of what I do is just try to suss out the sentiment from our clients, which are institutional investors. And it really was like, we'll just wait and see. You know, we'll just see what happens next. And I think what's happened in the last 2 months is they've realized they can't just keep doing that because, one, you know, those who de-risked and degrossed, they got caught and didn't get the rally. They missed it. So now that's why I think you see this deployment of, I think they're right tail hedges, but this extreme bullishness in IWM, so the small cap proxy. A lot of this is them saying we've got to do something, even if longer term we're still a little bit more negative, but we can't just simply continue to be frozen in deer in headlights.
You think that's the right bet if you have to make a bet?
I think for now, yes, because what you've seen is, one, you know, there is still a little bit of market management by Trump. You know, that tends, I think what we saw was a little bit more towards the bond market, but it is there. But the second aspect of it is what we've actually seen investors do is they're going to sectors that are just tariff resilient. So maybe your COGS are not all overseas, maybe you're more services oriented, and we're seeing them deploy those option trades on those sectors rather than say, you know, I'm going to put my finger in the wind and say, this is what I think is going to happen with tariffs. I still don't think people know, and they're watching the negotiations.
So for people watching the macro this week, we're waiting for the inflation numbers, the CPI and the PPI. What are you looking for?
I'm certainly looking at those. What is interesting is, and this was true prior to NFPs last week, is if you actually look at that at the money straddle pricing, so essentially just the magnitude of what the options market is pricing, it's very low. It's pricing almost nothing happening. And I always think that's a little dangerous because, again, you got that tweeter risk, you know, that is always in this market as an overhang. And right now, it just feels a little complacent. And I think the folks who are going to do something about it, they have their thumb on that right tail hedge.
So there's not big premium in the puts or the calls on the strike price.
Exactly. So it's not sort of saying directionally one way or the other. It's just saying overall those premiums are quite inexpensive.
That's a buy then, because you wouldn't want to sell it.
Yeah. But you know, that's what people are doing, Joe. They're
selling them. That's why they're low.
That's why they're low. That there's a lot of I'd say premium harvesting, volatility suppression related to just people just wanting to collect yield right now as they wait and see. And that's where we kind of find ourselves in this environment.
Can't believe I used to do that with S&Ps. Only I'd sell the calls and the puts. And in a month between expiration, I thought I was going to be bankrupt or lose my house. And then, but usually it would end. Usually it ends
works,
right
though,
there. Right? Yeah, but you got to have a lot of nerve because it goes both ways.
That is true. You can hit a pothole if you do it, but it typically there is a vol risk
Many times
premium.
it's settled right at the strike, and you just have to keep all that. And it was during a period of volatility, so they were both really elevated the premium. But now I just use DraftKings for $5.
Oh, great.
It's a lot better.